Okay, well, good morning again, everyone, and welcome. I am Dr. James Stapleton. I'm the president and CEO of the Codify Foundation on Rural Innovation, and I'm thrilled you have joined us this morning. Over the next hour, we're going to explore something I believe is genuinely transformative: how venture philanthropy and co-investment can create lasting compounding impact in regions like ours. So let's dive in. Here's what today looks like. We have a 45-minute presentation scheduled, followed by 15 minutes for your questions. And trust me, we really do want your questions. We hope this will be more of a conversation and not just a lecture. Please put questions you have in the chat thread throughout the presentation, and my teammates, Charles and Crystal, will share them during our Q&A session at the end. Our goals are pretty straightforward. First, we want you to truly understand the venture philanthropy model as we describe it, what it is, how it works, and why it's different from traditional grant making or charitable giving. Second, you'll hear directly from practitioners who have built and managed these funds successfully. And third, we'll explore what this could mean for Southern Missouri specifically, and potentially many other regions like ours. Now, quick note on what we're not doing today. This is an educational seminar. We're not discussing specific fund terms. We're not soliciting commitments, and we're not providing individual investment advice. Today's about shared understanding. So with that, let me introduce our incredible panel. We've assembled an amazing panel with deep hands-on experience in this space. Lindsay, would you please start us off?
Sure, happy to do that. Hi there, everyone. My name is Lindsay Karras Stencil, and I am a seasoned vet in the what I would classify as economic development coupled with venture capital space. I've spent about 20 years working with and for families of venture funds, but also have served as the COO as well as the chief investment officer for an organization in upstate New York. So everyone thinks New York is kind of, they get all, New York's a great place, lots of resources and dollars. That's true for New York City. But if you're not sitting in New York City, the rest of that state does not get a whole lot. So we had to figure out, how do we create some economic development opportunities surrounding entrepreneurship and invest in new and upcoming industries, entrepreneurs, founders, to create new jobs, opportunities, and get people to want to stay in region. And so through that, created a series of for-profit and nonprofit vehicles that can invest collectively into startups across the country, across the region. And we ran through that, the most active seed fund in the state of New York for 4 consecutive years, and have invested to date in over 100 companies, and have 6 exits producing returns to date. So it's starting to bear fruit. And so that labor of love has been wonderful, but glad to be here. I'm also a partner with Thompson Hine full service law firm, and have worked with the Codify team and many a folk in Missouri, the great state of Missouri, to accomplish some of the goals and things that we're going to talk about here today.
Thank you, Lindsay. And as everyone will hear during the presentation, Lindsay is a trusted advisor of ours, and we're really thankful to have her. Speaking of trusted advisors, welcome everyone, Ed Frent.
Hi, everybody. Thanks again for having me, James and Codify team. I am based up in Kansas City, and our venture capital fund actually invests in also a limited geography of Western Missouri and the state of Kansas. So we were formed in 2016 by a financial advisor, Darcy Howe. She had 30 years of experience at Merrill Lynch here in Kansas City, and and I know there's many advisors on the call today, so good for background. But it was more of a there's a problem here. There's a lot of great entrepreneurs. They're typically don't come from the capital markets or the money, networks in town. And there's really helpful, really eager investors who have their own on the angel side, angel investors who have their own full-time jobs and running companies themselves, but want to participate in building the next big companies of the region, and also helping mentor, because that's really an awesome thing to do when you're investing in your neighbors, like we call it. But we were able to raise a $19 million fund at that time. I joined in 2017 from Chicago. I have more of an accounting, investor relations background from a private equity firm in Chicago, and also glad to answer any questions on just the differences between PE and VC in this call, if that's helpful. But I was really lucky to join up with Darcy. My wife is from KU grad, and I've enjoyed being new to town, but also feeling how welcoming it is, and I can get more into that as well. But this is kind of a cool job for making connections and helping uplift, budding talent, founders and talent joining the companies, which is also a big part of this. But yeah, thanks again for having me, James.
Yeah, thanks again, Ed. And I mentioned earlier, I'm James Stapleton with the Codify Foundation, which we started 11 years, 1 month, and 1 day ago exactly in Cape Girardeau, Missouri. Our organization's still headquartered in Cape Girardeau, but I am now and have been for a little over 2.5 years based with our team here in Springfield, Missouri, in the southwest corner of the state. And I'm obviously co-founder of the Innovate Somo funds, which we'll discuss in some detail later. And between the three of us, we've helped deploy tens of millions of dollars in venture philanthropy and other forms of capital. And I'm really anxious to just jump right in and start looking at how this work has evolved in practice. And Lindsay, I know that you kind of alluded to some of your work with Launch New York, but please kind of take us through a case study so our viewers today get a sense of really what you were able to start there.
Sure. So Launch New York is a 501c3 venture development organization. And so it focuses on the western portion of the state. So not New York City, not Long Island, but the westernmost counties going all the way to the Pennsylvania line. And so that organization originally started in 2012, and we focused at that time primarily on providing mentorship to founders. And that was provided through seasoned folks who have either assisted with taking on capital, have raised capital themselves, have grown or exited businesses, and have skill sets that companies may need. In 2016, we received our first larger chunk of funding from the Ralph C. Wilson Jr. Foundation. And so that allowed us to capitalize what we call our nonprofit fund. So it is a wholly owned vehicle owned by Launch New York Inc., the 501c3, to make investments into startups. And then in 2018, we said, okay, there's a lot of folks who are very interested in investing into these startups, but they don't want to do it in a donation format. And that was all that Launch had available through that time frame. And so we had a number of people coming to us and asking, hey, can we invest with you? And so we started a for-profit fund at that time, raising, the first fund was a smaller fund. It was about $5.4 million. And it allowed us to then invest in north of 60 companies out of that fund and the nonprofit fund combined. So those two vehicles would co-invest with each other to increase the amount of capital that companies would take on. So that organization is also what we call a community development financial institution. It's one of the few venture CDFIs in the country, which allows us also to take on grant capital from the federal government to invest into companies as well through the nonprofit. And so through all of those vehicles, the organization has now mentored nearly 2,000 companies. So I was just coming from a meeting here today with the CEO of that organization. And so in 2026, we will cross that 2,000 companies mentored mark. And because of that, we have stimulated north of 9,500 jobs in the greater ecosystem and community, which is a very big deal when you're thinking about population bases that oftentimes will find them being rural or without substantial anchor businesses or industries. That's a really great opportunity for the ecosystem at large. And so it keeps people in the region, it keeps people caring about the region, it keeps people excited about the region. And in addition, it creates ultimately tax revenue as we're growing these businesses or selling them that allows us to keep people engaged and coming back and continuing to invest. So now the exciting thing that we're starting to see is we recently had an IPO out of one of the companies back in 2021. Many of those founders of that business have doubled down and started new businesses. They have invested in countless companies throughout the region. So it gets a flywheel turning of creating excitement, creating jobs, creating opportunity, and most importantly, building the region that we all care about. I saw a question pop up here. What is the name of the venture CDFI? It's Launch New York Inc. is the proper name of that. So that CDFI designation is held by the nonprofit organization there.
Thanks, Lindsay. And obviously, if folks have other questions for Lindsay about Launch New York, please throw them in the chat and we'll get to them as we go or at the end. And it was amazing for me when we began considering trying to put some pre-seed funding together to fill gaps in Southern Missouri and having such a difficult time finding both legal but also entrepreneurship support and startup minded folks to really help us swim through all the different options in how to organize and different models that we could use and then we found Lindsay and she's been amazing and we'll get into a little more of some of the things that we're hoping to have some of those same kinds of success. Likewise, I've known Ed for a while, and although Casey Rise Fund is organized a little differently, we've drawn a lot of inspiration from what Ed has done. So we've asked him to kind of case study out Casey Rise Fund and tell us about more of the details of his work in Kansas City and over in Kansas.
Awesome. Thank you. Well, I'll keep it brief because we have, I think, maybe a more simple structure in terms of our fund is we, like I mentioned, we gathered people who wanted to invest in startups locally to come into a fund, which would be more akin to a mutual fund, where they don't have to make decisions on which companies they're investing in, which a lot of the folks in this, they don't want, it's not that they don't engage afterwards. It's just that they'd probably want to see what companies are in the portfolio and then pick one or two to either further invest in personally or spend their time, helping problem solve or making customer introductions. But beyond that, it's a pretty simple vehicle where we have about 100 investors come into. And it's a lot of investors, but it's also a lot of great networks to capitalize on. And I'm sure James is seeing it that way as well. But it's about a $250,000 or so, average commitment from these investors. But the Greater Kansas City Community Foundation was actually our largest investor in the first fund back in 2017. And they were 2.5 million of the 19 million that we built. So a very significant portion. But the rest of the fund, contrasting from Launch New York's first fund, our founder was very much like we are return-seeking investors. I think she mostly called it decidedly for profit, just so there was a distinction, but with an impact lens. And like I said, at that time, it was job growth, keep entrepreneurs that may leave for the coasts because the capital they need is there, um, and really be a support organization, but look for the high growth returns. So the stage that we come in, as James and Lindsay mentioned, is sort of what we call seed stage, which is after friends and family, maybe after some one or two angels come and invest in the company at maybe a couple $100,000 of investment. It's that first round after that. So it's the first institutional round of capital. And that typically is the company's still pretty young, but has 5 or 10 employees and has we like to look for companies that have revenue. So not pre-revenue, in the 10 to 20,000 recurring revenue a month is where we kind of point entrepreneurs with a couple different customers, not all just from one customer. So that's where we kind of, just to frame it. And then we really like to know as many venture capital firms around the country to make the connections for these usually technical founders, engineering founders. Again, they're not coming from the networks that they probably need to raise the next round of money from. So hopefully that helps show the timeline of like local, then national, and we really like to be the connector to then the national, and then we typically invest more in that next round too. Um, I would say the really cool thing about the greater KC Community Foundation, and I know, James, we've talked a lot about this and the impact that the Community Foundation of the Ozarks has had, and is those investors can kind of come in below the $250,000 minimum that we had down into like the 50,000 or 100,000. And again, that's it's on a capital call basis. So it's typically drawn down over 3 or 4 or 5 years, which makes it a lot more, just approachable for younger up and comers. I might get this wrong, so don't hold me to it, but I think you can also, if you're not an accredited investor and you invest in this kind of fund through the community foundation, which means you've donated the money and any profits will come back into your donor advised fund. Younger folks can participate in that because they don't have to meet the accredited investor rule, which is, uh, I believe, over $1 million of net assets and a base salary a year, which is just not where a lot of people, that want to partake in this venture world, are able to. So it's kind of a cool democratization of investing in private companies, like we call it, and the foundation folks, those that come in through the foundation, we treat just like a normal main investor. So they come to all the events. We offer them co-investment opportunities. We ask them to help. If you know a customer or if you know somebody at Garmin or H&R Block or some of the big companies in town that one of our companies is looking to meet, they help with that too. So that's kind of how we are in the community foundation, impact capital realm, but a little bit different than what Lindsay and James are doing. But glad to expand more or answer any questions down the road. Uh,
Thanks, Ed.
and I just saw a question come in, really good question that I should have hit on. So does Casey Rise co-invest with corporations? And I would call it more the corporations that are also curious in investing in local innovation and just generally supporting new job growth and bringing talent to the region. They actually would typically invest in our fund and be a part of the investor group, and then they don't typically invest directly in the companies with us. They're more, again, kind of supportive capital, patient capital is on this slide, and I think that's a good way to put it, and probably where our corporate investors, some of the corporate investors are ESOP, employee stock option structures. So, and when I say these corporations, they are not in through the community foundation. They are like in the, for-profit, profit-seeking part of the investor group. That's been a really cool unlock that the ESOPs, like the young folks of those companies, in their sort of, I guess, profit sharing like vehicle can be invested in local companies, can be attached to local companies, and also maybe participate, in the upside through, via their ESOP. So glad to expand more on that. That's kind of atypical for venture capital and private equity. Usually there aren't corporations investing for a variety of reasons. It's usually more the endowments and the family office sectors. But yeah, great question.
Thanks, Ed. So really trying to kind of ground really the rest of our discussion, I guess, this morning in practical application and sharing case studies from these other two regions. And we did want to take a little bit of time, and we can move through this part of our program pretty quickly to kind of touch on, frankly, even as we're kind of coming up to speed on options and kind of the emerging trends in some of this evolving capital space, and really the blending of these kinds of investment vehicles that are taking places in other regions or that we could leverage in Southern and other areas in Missouri. We really took some time to try to look at different models and some of the opportunities and benefits of more of this co-investment model. So I think, Lindsay, you were going to maybe make a couple of comments here on sort of with your experience, some of the challenges, maybe opportunities or dilemmas that existed with the purely traditional models.
Yeah, so I mean, there's and just so I can make sure I'm giving everyone the correct mindset here, do you want me to talk about traditional nonprofit or for-profit or both? Because I can run through both very quickly.
Yeah, I think really what we were capturing here is kind of talking about the way that traditional philanthropy works
Got
and
it.
and how
Yeah.
traditionally deployed and delivered.
Yeah, so traditionally, with grant applications, they are very lumpy. So different folks have different time frames about how they will deploy their capital. There's usually a pretty arduous application process. It takes a tremendous amount of time and truthfully a sophisticated grant writer to get very large size grants. And then those are typically procured for a very specific program. And so maybe that can be for deployment into investments into startups so that the money that comes back to the nonprofit that might receive them is then able to continue to what we call evergreen those dollars, which means they can continue to reinvest them. But that's a pretty long cycle. And so grant might get made, program gets delivered, meaning whatever it is that you are supposed to do with the dollars has to be done. It has to be reported on to the grantor so that they understand what impact was then being produced, because that matters, right? They're giving these grant dollars because they themselves are trying to drive towards an outcome. And then at some point in time, the capital from that grant is gone. It's not revenue like many of us for-profit folks like to think about, where it's recurring and it's steady. It's very lumpy, it's unpredictable, there's very long cycles. There is, just because a grant group might say, hey, we're going to deploy this capital in January, it's on their balance sheet. They can deploy it in January or they can do it in May. And so when you're planning for January and you don't get it till May, that can make things very challenging. And so when you're trying to run investment programs and other similar vehicles and you're making promises to companies, that can produce a very significant rub. Those dollars are important, certainly, for nonprofits, and the impact is significant, and it's a necessary component of oftentimes what needs to happen in these economic development vehicles. But oftentimes, because it's not predictable, particularly with the state of the affairs, with things being reconsidered at state and federal levels, there has to oftentimes be pathways where you're thinking about how can you make more steady investment opportunities or procure capital in a more predictable, linear way.
Yeah, and I think that was a good tip into this next slide, Lindsay,
Correct.
and really the idea of the evergreen model. There are so many terms bantered about in this startup venture space, but maybe let me just kind of walk you through kind of the differences as we see them. Obviously with a traditional philanthropically funded grant, let's say $1 million, it goes out, creates $1 million of impact, and then not that that impact doesn't have lasting um, uh, effects, but then the capital is gone and not being able to be at work anymore, and maybe in some ways then is sort of the end of the story. With venture philanthropy, that same $1 million is invested, not really just spent, and returns can be generated, and that then capital recycled back into the fund. And I think that is a very alluring element from our standpoint. The work that I think all of us share in and are doing is really how could you get the benefits of both? And so the compounding, the mathematics of it all, work in progress. I mean, as we illustrated here, in years 1 through 3, that $1 million fund is able to get 10 to 15 companies started. In years following, some of those companies start to have exit events or liquidity events, or they're acquired, they grow, they continue to provide economic impact. And those events, if they have them, obviously generate returns that flow back into these funds. And then, all the way out, as Lindsay described with Launch New York, and I know Casey Rice Fund has had some success at this phase as well, but you start to see these exits that happen in a small percentage of these companies, but they make such a giant impact when they do happen. And this is really the power of the evergreen philanthropic mode. Your gift keeps giving over and over, and funding generation after generation of entrepreneurs, at least in the case of the work that we are all working on. So these structures, Lindsay, I remember first meeting and talking with you. I thought maybe you could share with our viewers today just some brief insights on sort of how the impact gets amplified through these vehicles.
Yeah, certainly. So different places can set it up differently, but for our purposes here today, we talk about these co-investment structures working collectively to both maximize impact of the nonprofit that we might be discussing, in this case, Codify, and then also how do we create opportunities for generating returns for more traditional investors. And so do well and do good. Okay, so on the nonprofit side, some individuals, family offices, businesses, the thing that they are looking for might be donation, tax deduction type of write-offs and offsets for their taxes. And 'tis the season. But so one of those ways to do that is to donate, in our case here, to Codify Foundation, which then can pass those dollars, can direct those dollars into its what we call nonprofit fund. And so that nonprofit fund can then make investments alongside the for-profit fund, which I'll talk about in 1 minute. And so that's how that impact can be seen. And when there are returns, those come back to the nonprofit Codify and can be reinvested over time, that evergreen structure we were just talking about. For um, the more for-profit side of the fence, that is a very traditional return profile. But I would say, in this instance, actually a little bit more attractive because oftentimes when you have a for-profit investment fund, you have what we call management fees, and you also have carried interest. And so management fees are paid to the management of the vehicle to do their job. And then the other side of that is for to share in the profits. It incentivizes the management team to do so. Um, you know, in Codify, because they are nonprofit driven and mission driven, those expense functionalities don't exist. So it creates, true investment opportunities. So returns that come back could be, if there were to be some, would truly be returns for the investors if they were to ever occur. Now, the other side of that is because the nonprofit and the for profit are collectively working together, the nonprofit can actually absorb if there was a return and it didn't return 100% of the capital to both of these vehicles. The nonprofit does have the optionality to absorb more of the losses, and so that the for profit entity could receive additional benefit as it relates to that. And so because we can couple those things together, it creates a nice opportunity to generate that true impact on the nonprofit side or those tax deductions, but also create kind of a unique opportunity for investors if they were thinking about, hey, this might be a really attractive vehicle for me to have a possible impact. And if the companies win, they win. But even if the companies only moderately do well, they've still very positively impacted their local community.
Well, I think that's what we were really seeking, I think, in southern Missouri was a way to leverage, I think, what exists greatly in the region, and that is the philanthropic spirit that is in the region, and coupling that with opportunities to spur on more economic and community impact through these startups. So that leverage benefit, speaking really of Southern Missouri, and why we think it's a good fit for these types of structures. First, the reality. Unfortunately, like many other places like it, we're a bit of a capital desert. Pre-seed and seed funding's nearly non-existent in the region, or has been in the past. Traditional venture capitalists sometimes won't travel for small check sizes that early stage companies need. And the result, unfortunately, is that high potential startup companies are forced to relocate, seek funding from other regions in the country, and many times take the economic impact of and potential impact of those companies with them. So the opportunity in the region is really exciting. We actually have real competitive advantages in specific sectors in our region, and we're working through a variety, a network of partners across southern Missouri and other rural regions in the state to leverage those. So we think of healthcare sectors and ag tech sectors and manufacturing, really the industry sectors that the economies of our regions base their success from, are really ripe with opportunities, especially with some of the modernizing technologies going on and driven through AI to spur up, an innovation timeframe and new era with leveraging those new technologies to solve old problems, not in unfamiliar industries, but in ones that are really anchored in southern Missouri. And one fact that we really have always been driven by at Codify and our partners in the Show Me Network is that with high-tech focused companies, there's this job multiplier that is really in the top one or two in the state of Missouri, where for every job we create in one of these companies, there are nearly three additional local jobs created. And that's driven by the types of above average or median salaries paid in many of these companies and the pace of growth that many of them actually exhibit. So um, while we're a bit of a desert, like some other places that are like us, we do have some of those advantages. And quickly, I think we'll move through a couple of other topics that some of you that are just introducing yourself to this venture philanthropic model, you may want to look a little more closely at. But the range, I think we've talked about this, some of the range of advantages for a variety of different types of donors, major donors, corporate, family foundations. Obviously, there are distinct advantages in some of these non-traditional models that are worth taking a look at. Lindsay spoke a bit about the governance and structure and some of the best practices that exist and are talked about on the next slide. There definitely are a variety of ways to organize structures within these operations. I think Lindsay talked about them, and we can definitely get into more discussion about them in the Q&A. I think one thing that's important from a best practice standpoint is funds of these types are often led and advised very closely by what are called investment committees. And so, especially on the LP fund side, it's really important to have representation from the startup community with expertise, from experienced angel and venture investors, from operators of these types of companies, high growth, high tech companies. As people hear me say, often are not the same beast as their small Main Street friends down the way. And so therefore, it's really important to be able to connect founders of these companies and teams to some expertise. And that even goes into the sector domains that they're operating in. Unless you're a domain expert with lots of experience in your industry or in the field that you're solving problems in, it's important to get that kind of experience as a part of the fund. And I know Ed and Casey Rice Fund are really good at the sector-based kind of activity that they do. And then we combine those with the philanthropic mission experts as well to kind of balance out the governance and structure. We want to spend just a couple of minutes kind of sharing with you then, kind of bringing this to home, what we're building right here in Southern Missouri. And the Innovate SOMO funds launched really in 2025 after being formed in 2023. Our geography or the region we're serving covers 47 of the southernmost counties in Missouri, nearly half of the state. And we do deploy this dual fund model, a nonprofit fund and a for-profit LP fund that work together. The nonprofit fund co-invests alongside the LP fund, matching terms, and is structured to be evergreen, with return cycles recycling back for future investments. The for-profit LP fund, as we've discussed, is designed for accredited investors seeking market rate returns. And as Lindsay mentioned, we're mission aligned in the sense that our LP fund does not charge administrative fees or require carried interest. So our investment focus is a little earlier stage. One of the big gaps or maybe the most obvious gap in our angel and venture funding in the region is pre-seed, really when companies are working with proof of concept products, are beginning to acquire customers and generate revenue. This is the hardest stage really for us to help them acquire capital. So we kind of sit in that pre-seed area. We are planning to deploy checks from sort of $50,000 to $250,000, but I would say especially in pre-seed on the lower end of that spectrum. We will and are planning to make some seed investments, but they would be sort of early seed, maybe just a little earlier than Ed described the place that Casey Rice Fund sits into, and those investments may be a little larger. We are targeting industries that are healthy and growing with opportunity in Southern Missouri: health tech, ag tech, manufacturing, even some fintech. And as I mentioned before, with the onset of AI, most of and many of the companies that will be a part of our 15 to 25 investment portfolio will have an AI focus. So what makes Innovate Somo different is really that we're not just a fund. We're part of a complete development ecosystem. Those of you familiar with Codify and our work over the last 11 years know that we have been able to provide local entrepreneurs and career professionals technical training today that is rapidly changing and has over the last last couple of years. Vibe coding and other agentic AI-based coding methodologies have really just almost immediately replaced many of the older ways of developing software. And we're leading once again in Missouri, providing vibe coding training, agentic training, even announced the first Vibathon or vibe coding hackathons in Missouri recently, with a statewide tour being planned for 2026, really doing our foundation's mission in providing access to these skills that are sometimes harder to find in places like Southern Missouri, but really across the state. Next comes startup validation and traction. Traction Studio AI provides really intelligent tools and technical assistance. We provide specific training for the startups that we're supporting in raising capital, and obviously really being able to then lastly in our pipeline deploy this capital from our new fund. We're excited to share that we've already had some significant momentum, and really on the capital commitment side, with the Innovate Somo funds, we've secured $700,000 in commitments from local donors and about $1.3 million in regional limited partners to this point, all before really doing much public fundraising and campaigning. Lead investments on the philanthropic side have come from the Hatch Foundation here in Springfield, and a very generous anonymous donor from the Cape Girardeau region. And we've even been fortunate to get the support from some corporate investors like the Bank of Missouri, who invested $100,000 really to help us cover operational cost, even legal formation costs, so that we didn't have to charge fees associated with our fund. And we've received a portfolio transfer of some previous angel investments from Missouri State University's eFactory and the Accelerate Springfield Fund, giving us immediate deal flow even before our first deployments, which should be announced soon. On the ecosystem support side, we have a partnership with the Community Foundation of the Ozarks. We received a $2 million EDA build to scale federal grant that helped us do a lot of the startup development work that we have over the last couple of years. Missouri ARPA investments, and also have for many, many years received outstanding support from the Missouri Technology Corporation programs and their grant program. So, and for legal and regulatory infrastructure, as we mentioned earlier, Lindsay and Thompson Hines team is really handling and has handled our fund formation and management. So we really feel like we've been building this the right way. So why does this educational session matter? We think it's because venture philanthropy only really works when everybody in the ecosystem understands it. We need informed donors and foundations who understand how PRIs differ from grants and why co-investment creates the kind of leverage we've talked about. We need engaged investors who see mission-aligned returns are possible outside of the coastal metros. We need supportive community leaders who recognize catalytic capital's role in economic development. And we need equipped entrepreneurs who know resources exist to support their growth and be able to stay home. Today's goal was simple: to share knowledge, and when everybody understands this model, everything else we think will follow. So I wanted to just quickly summarize, and then we're excited to get into questions that may have come into the chat. There are really 6 critical factors that we think about as we consider what makes venture philanthropy work. We hopefully have talked about many of these and maybe provoke some thoughts with those of you who are viewing about ways that you could get involved, whether it's in our regional efforts here or other regions that you may be working in. And lastly, I think from a portfolio strategy standpoint, I think there are things here to think about. Ed, I think it was interesting in learning early on about how Casey Rise Fund came to be and the large investments that your own community foundation made. I thought you might want to just talk a little bit here about how you all have viewed sort of portfolio strategy, or add anything to the previous comments you made. Come off mute real quick, Ed.
There we go. Yeah, absolutely. And there's a question in the chat I could probably tick off as well from Chris on just how do we evaluate the companies, because there's for every one investment we do make there on the coast, they'll say they probably make one out of every 500 that they meet, but for us it's still one in every 10 or 20, and the others we want to help get. The others would, the other 9 out of 10 would still be too early for us, but we are trying to raise all players and tell them, hey, here's how we need to what you need to achieve to come back to us or to the firms we work with. But we actually don't have any secret sauce on that. We have kind of a submission form. We have we have kind of, it's sort of cliche, but it's sort of like a network driven, or you meet these companies at other places around town, then you meet with them directly for a couple times, get a sense of what they're building, show them to some other investors. There's a little bit of group action, I guess, in venture capital, which is a big difference between private equity, because usually the venture capital rounds are not just one, would not just be just Innovate, SOMO, or just KC Rise Fund. We need a couple of professional firms, we need a couple of high impact angel investors, and we need to build like a syndicate for that. So it's evaluating the deal and evaluating how to get others motivated to come into the deal. But I'll of these, I think I'll just touch on the sector focus, because when we were early, we were very broad. I know we were trying to help everybody, and that started to include consumer product companies, food startups, and medical, deep medical technology, which all have their high upside as well. But we realized, okay, like software, pure software that has high margin and high growth potential, and can typically grow big enough in a 5 to 7 year time frame to be acquired by a public company or a big competitor. It just fits best for us to be software. So within software, that was even still pretty broad, and we've really honed in on healthcare, government technology, which is strong in KC, and like supply chain logistics. So Not that we only do those three, but I think James is on the right path. I mean, this is really hard to do. You need to start seeing some pattern recognition, and that on the healthcare side. And then Rachel Anderson at eFactory introduced me to the Cox Health folks. One of my trips down to Springfield, they seem to have a real, they seem to be a real great partner to work with a, health system that can be your eyes and ears to what in AI is most impactful to customers and also on the rule, like just a lot of the impact of administration, changes and things like that. Like rural health has there's a lot of problems to solve and venture capital, impact capital, and John, I think, mentioned the term catalytic capital in the chat. Like that's actually a really great healthcare and the advent of AI to remove a lot of the costs and barriers and insurance, hoops and things like that within healthcare is I think a great place for this type of capital. But happy to dig more in the weeds with anybody that would like to, after the meeting.
Thanks, Ed. And I think the last slide here we had is really just kind of capturing the concept that with our work in Southern Missouri, we're obviously attempting to, kind of use the model in the way that it was designed to help our region be able to experience the kind of economic and social impact that we can. I think I'm going to jump maybe on Ed's cue a little bit into the chat, and I can take a couple of questions. And Lindsay and Ed, please jump in and add anything you'd like to. There was, I think, Chris from Elevate Branson asked a question about how a fund like ours, I think Ed talked a little bit about sectors they work in and how they evaluate. And since you're such a close neighbor, Chris, I wanted to be a little specific about Innovate Somo. So we do have, as most funds do, an application process. We tend also to have a pitch competition. We had a competition in the late summer timeframe that was kind of the first of our fund. We've had lots of pitch competitions over the years, but for the Innovate Somo Fund, our first competition, we had 16 companies from around the region that participated that were really early idea stage all the way to companies who are substantial monthly recurring revenue, have raised considerable capital already and are looking for additional seed investments. And I'm excited to say that we, with the work of our investment committee and our team, have been able to diligence through a lot of that work that we had done for Invest Somo, and we'll be announcing soon the first deployment from our fund. And I won't get into the specifics of it, but really should be somewhere in the $1 million range and fewer than 10 companies. So we're excited to be able to do that. Our evaluation process is really based on our experience as operators of software-based startup companies, as well as people who have worked with to support founders for many, many years doing the same. And it's really driven a lot on our philosophies around traction. And so we get into the weeds probably even more than most funds, because we do serve as a support organization that is very program heavy on the tech software focused development side, and really do our own evaluations using now much of our own AI developed technology to help accelerate the pace of that evaluation, to really test a lot of the assumptions about the validation that the founders of these companies suggest that they've gone through. We're looking for real understanding of traction metrics. We're looking at funnels of customers that have been validated, so we know there's considerable desirability. We're looking for developing understanding of what it costs to acquire and convert those customers, and not to get into the weeds too much for for our webinar today, but that's important. It's that early traction many times that prevents someone that has a great idea, as oftentimes people say, from really being able to be successful executing that. So we spend a lot of time and diligence there. We are software completely focused in our Innovate Somo funds. We can be agnostic to industry to some degree, but do focus on the industries that are the strengths of the region. And because of our technical backgrounds, we're very also focused on being able to unleash the potential that AI has for many sectors and being able to solve problems in better new ways than even current technology does. There was a question asked about the contribution that the Bank of Missouri made, and it was a $100,000 contribution into or donation made into our 501c3 to support this effort. Justin asked, and I'm just working my way through the chat, how I see our relationship with the E-Factory evolving. As people from Southern Missouri, especially Southwest Missouri, know, we've been longstanding partners in our effort to accelerate innovation-based and tech-based economic development in Southern Missouri, and we remain close partners. We occupy space in E-Factory, two of E-Factory's facilities in Springfield, and continue as technology changes to really look forward to being partners in the work that they and the university do here in Southwest Missouri, as well as our other partners across the Southern Missouri area. Daria asked a question really about do any of your portfolios include investments in physical spaces or community real estate? Ed or Lindsay from Western New York and Casey Rise Fund, do you guys play in those spaces?
I'll jump in. So not typically, though sometimes as part of a company's taking on capital or raising capital, part of that might be facility expansion, real estate purchase, or very large long-term lease and manufacturing development. So we might see investment kind of indirectly into real estate, but more typically investment into real estate sits in the real estate investment trust or very specific real estate oriented funds.
Yep, same for us. And maybe worth looking into though some of the dollars that have been allocated to each state through the SSBCI. I may have this wrong, but like the some of those dollars, I believe, can go into software companies, but other of the dollars are going into physical space, like placemaking grants, and I think of things like that. So Missouri Technology Corporation, Grow Kansas, each state has really good ones that I think they dabble in that space.
Yeah, thank you. So I think we are a little over time. Time went by very quickly. There are a couple of questions in the chat that we will respond to when we're following up. And I think the last thing we wanted to do was to make sure that we provided an opportunity for everyone to be able to reach out to Ed, Lindsay, or myself. So in the following slides, there are QR codes and handsome photos of our wonderful panelists today with my exclusion. So these would be ways to get to the website where you could contact and LinkedIn accounts where you could contact Lindsay and Ed. We will be sharing the slide deck and the video of the webinar this morning. We'll get that out to you before the end of the week. And so you'll have a chance to use these QR codes then again, if you're able to access those slides. I am pleased to also say that in preparing for this webinar and in the conversations that we've had with Lindsay and Ed and others over the last couple of years as we've been doing this work at the Codify Foundation, we've co-authored with the two of them a white paper that we're making available to you, and we'll be able to send that out to you as well. We invite you to share that and any of these other materials with anybody that you know that you think could benefit from them. And obviously, we would love to connect with anybody either in Southern Missouri, across the state of Missouri, or anywhere else that we could provide some assistance in doing any of this kind of work. I want to end in thanking our partners at the Codify Foundation, a grant from the Missouri Technology Corporation, something that Ed had just mentioned for some ecosystem building, made this project possible. And so we appreciate them, the wonderful partners here in Springfield we have with the Community Foundation of the Ozarks, clear across Southern Missouri, our own Show Me Network, and our partners at the eFactory. Thank you all again for taking your time to participate today. Ed and Lindsay, thank you. Look forward to seeing you both soon. Happy holidays to everyone, and God bless.